this move in dollar yen had nothing to do with the status of the two economies. It wasn't because suddenly the Japanese economy's prospects became so much stronger vis-a-vis the dollar. We know that's not the case. It doesn't make any sense. We know that the prospects of the Japanese economy's performance vis-a-vis the European or the British didn't suddenly become stronger because Japan had an earthquake. But what happened is the way trading rates are calculated through the crosses, this move, which has more to do with market positioning stops and probably repatriation than anything else. But this specific move that we're looking at here is nothing more than a very dramatic stop-loss execution run. And you know it's true because, where's the pointer? Okay, because this is where we started, and when the run was over, where did we finish? Right exactly in the same position. That is the most typical type of stop run you can possibly have. Nevertheless, it looks dramatic as hell. It was dramatic as hell. I was sitting at the desk. I told you, I was feeling, 15 years younger. When I used to actually be in the middle of those things, executing the orders, which I'll tell you that we still have some time, so I will tell you how the actual mechanics of what happens here and why it moves like that. But when you get a move like this, you also necessarily, because it's a mathematical construct, get a move in the euro-yen. So because the euro-yen is a product of the multiplication of the dollar-yen rate. Yeah. Did I say yeah? That's what my kids are saying. Yes, please. Euro-yen. Put it on a 5-minute the same way. Yeah. And you're going to see an identical chart here. This is identical to the dollar-yen chart. Okay? But what is happening here is not that the relationship between the euro and the yen is changing. What's happening is that the component, because how do you get to the euro-yen rate of 110? You multiply the euro rate by the dollar-yen rate. That's all you do. Believe me, traders are not particularly good at mathematics. Arithmetic is all we can handle. And after that, we move on to the computers and the quants. So when you change one component of a multiplicative relationship, the other, in order to maintain, as you've seen here, nothing happened in the euro-yen. We ended right back at the same place. But in order to do that with a different dollar-yen rate, you must have a correspondingly different euro rate. So what this forces the euro to do is go up, because you're maintaining, once we get through this, the euro-yen rate. And that ended up with a mildly stronger euro rate, because the dollar-yen is not exactly where it started from. It's come back down again. It's in the 78s, I believe, right now. What is the dollar-yen right now?
Dollar-yen 79.11.
Okay, so it's about 70 points below where it started yesterday. So that has to be compensated for by a higher euro, and that's the primary reason the euro moved, because there's no safe haven trade here. This is not safe haven. So what we're seeing is a reaction to the current popular word, an exogenous event, an event internal to the markets. That stop-loss run has all sorts of effects, but they're not economic primarily, and this is not an economic interpretation. The dollar-yen chart, which looks just like this, is not an economic interpretation or a currency market interpretation of events in Japan, except as far as it anticipates and perhaps was caused by, at least getting down to this level, by repatriation flows. It's just that nothing else makes a great deal of sense to me. When you're on a bank, remember, it's still the bank desks that execute the vast majority of the volume in the market. And one of the jobs of a bank desk is to execute orders for their customers. Their customers can be hedge funds, corporates, all sorts of types, but they all want execution in the market. Now, for a lot of these people, they don't actually have access to, or direct access, although it's much more common now, to clearing in the currency markets. So they will, if a bank has a strong corporate relationship with some corporation, then when they need to do something, they will call the bank and tell them to execute an order. They will also leave orders to execute as the market moves so that they're covered all the time should anything happen. These flows can be based on all sorts of things. It can be based on actual trade flows that they know are coming through. They can be based on covering for option positions. There are lots of things that can generate an order in foreign exchange. It can be sheerly speculative positions. Somebody's long, somebody's short, somebody wants to go long, somebody wants to go short. Just like us, looking at the bottom in dollar yen at 79.80, any technical analyst would have said, you know what? This is an excellent place if I can get executed to go short. Because what are we likely to get? Exactly what we got. Anytime you, in a heavily traded currency, which this is, also a currency buffeted recently by tremendous news in its country, even if the result doesn't make any sense, you're going to end up with an enormous amount of stops. Most of the market is speculative. The purpose of speculative trading is to make money. The tool everyone uses is technical analysis. Everybody comes to the same conclusion. So you have real flows involved, and you also have speculative flows here. They're all going to come to the same conclusion. If this thing moves very far below 80, I need to get out of my position because nobody knows what's down there, and everyone has the experience of this, knowing that this is quite possible. Knowing not only is it possible, it's very likely. So every trading desk, and I used to see this all the time, you get to a certain level, or close to a level, you look at your order book, and as a trader, you suddenly, within 20 points, you have to sell $300 million yen. That means you as a trader, you're responsible for this. This is your job, to execute this order, and to either make or lose, make as much money and lose as little money as possible in the execution thereof. What does an execution mean? It means that if the order is placed at 79.70 for $100 million yen, it means that my customer is going to sell to me at 79.80 or 79.70 $100 million against the yen, dollars against the yen. That means that I myself, as a trader, at 79.70 suddenly become long $100 million. That's a really big position. That's the kind of position that can destroy your P&L for 2 years and probably forfeit your employment as well. But if the market moves through that level, that is what's going to happen. You are going to get this on your books as the trader. This is what I used to do. Well, what is your defensive position against this? You've got to get rid of that $100 million as soon as possible. So partially what you can do is you can build up a short defensive position against it. This is undoubtedly what was going on all New York afternoon. Let me have this for a second. All New York afternoon. Because you know a couple of things as a trader, as a bank trader, that if I'm sitting on an order book that tells me I've got to sell $100 million at 79.70, so is everybody else. There's nothing unique, at least that would be my judgment. There's nothing unique about my order book. It's going to be duplicated on every bank desk in Sydney, Auckland, Tokyo, New York, and London that's still operating. So you know that once those trades start to get executed, the market is going to take off because everybody is trying to do exactly the same thing, which is sell in a falling market. This area right here, see this gradual fall in the yen all afternoon? My bet, now that's probably high, that's from 80. No, that's actually right, that's from 80. My bet is that all of this time right here, you have traders looking at huge sell orders just below 79.80, building up their short positions for the execution that comes ahead. And what does that do? That does force the market down in exactly that type of pattern. Who are responsible to execute these orders have no other choice. Not only that, this is the way the currency markets operate. There's nothing nefarious about this. This is the way they operate. They've always operated this way. And a market that combines, in a sense, universal access with individual responsibility, meaning the individuals are executing in a universal market, but they're responsible for the execution of the P&L. There's no way that it could be otherwise. It makes it fascinating. It makes it interesting. It makes it dangerous, but also risk profit potential too in a market. Not only that, there were undoubtedly a lot of people through here who were watching this knowing what was developing, who did not have any order books, but were taking short positions anyway. Why? For obvious reasons. They got a three-figure fall that they were anticipating, and they may have caught some portion of that. The reason you got such a rapid rise up is because once those orders were executed, then everybody who went short needed real fast to buy those orders back or to buy their positions back. So this is the most typical stop run I've seen in the past couple of years. So as the market approaches, there's one other factor involved in this, which is why it happened right at 5 o'clock. I can't tell you how many times I have sat through this. Believe me, it makes for a very, very nervous afternoon as a trader. It's not actually a lot of fun because you must pay absolute attention. Your decisions are second to second, and it's really nerve-wracking because you're sitting on a larger and larger position that is your responsibility. The amount of concentration required to do this successfully still impresses me, even though I did it. I'm not quite sure how it came about, but you learn how to do it, I guess. It's a lot like the concentration required in very competitive sports. At any rate, so there were a lot of really nervous traders in the New York desks in the afternoon and also in the Sydney desks in Auckland. Because the other thing that happens at 5 o'clock is New York banks all shut down. They will no longer quote prices. They will no longer put prices into EBS. They will no longer provide liquidity for their customers who need prices. All of that business shifts to either the New York night desks, of which there are a few, but most of them don't actually quote. They just execute, although I did quote when I was on our night desk. It shifts to the desks that will still quote, that still put in prices, which is Tokyo, if the people are in early. And many of them are. We used to pass our orders directly to Tokyo. So Tokyo had an early shift because Tokyo is 2 or 3 hours behind, I forget exactly, I think 3 hours, behind Auckland, which is the first market. So it's basically 4 or 5 banks in Auckland and Sydney providing all the liquidity. That's not enough for this kind of execution. So you get enormous price gaps. You get enormous moves because there's no price out there. You were seeing from us yesterday a continual, although very, very jumpy stream of 3-point prices. That's not the prices that were in the market. The price would go from 10 points to 50 points to 35 points to 60 points to 5 points for about a millisecond, then out. Back and forth for 20 minutes or actually probably for about 45 minutes. I'd have to actually look at the tape to see what it was. So, and that's because there isn't anyone in the market putting in prices. Remember, pricing in FX, in the interbank market, is purely voluntary. Sometimes when it's quiet, it's 2 points or 1 point in everything. When stuff like this happens, with less liquidity and vast amounts of volume going through, the prices will, quote, go out to a figure. I remember quoting people who asked me for a price in the midst of something like this, who were good customers in the bank and to whom I had to quote. I remember quoting them 2 figures. I would quote them 78 the figure, 80 the figure, as an example. And sometimes they would deal, and sometimes I'd still get buried. Sometimes I made a lot of money. So you will see this type of movement in the market and very limited range. I can guarantee you everybody's stop orders were between 79.50 and 79.80. Hundreds of millions of dollars of stops orders went through there, and the equivalent levels in the euro yen and the other yen crosses. Guaranteed. How do I know? Because I'm looking at the execution and how the market moved, and the only thing that drives markets to move like this are the things I've been speaking about. And the second reason behind this type of movement is the lack of liquidity in that market. The problem is, between the New York market and the Tokyo market, there is this low liquidity gap when the main market is Sydney and Auckland. And that is why these orders always get executed. Sydney has been known for 20 years as the stop-loss market. It either does nothing or it trades like this. Now, that's not exactly true, but as a descriptive,